Right now, the best numbers indicate globally, debt to GDP is about 350%. That is extremely high. It's up from 300% at the time of the financial meltdown some 10, 12 years ago. So that problem was caused by debt. And instead of solving the problem, we've added more debt. And some of the numbers are absolutely startling. I mean, Europe is at 420% of debt of GDP for debt. Japan, 550. The US about 370. China's above 300%, 330%. So these numbers are huge. Anything close to 300% is a problem. To have the world over 300%. I mean, that hasn't happened since World War II. And back then we had the option of just scaling back defense spending because we weren't at war anymore. Now we've got all of this entitlement spending and government spending. We all know, we remember 10, 12 years ago during the crisis, what was going on with Greece, Italy, Spain. Those countries are still vulnerable, and the rest of us are getting more and more vulnerable. Japan is the gold medalist, as I call it. Their debt to GDP ratio sky high, and they've really impacted their economy as a result of it. This global debt binge, which has been going on for really 20 years, remains a major problem and is not going to end well.
Or soon.
Yeah, or soon, right? Interest rates have never been this low for a long period of time. And as long as anyone can remember, the US Fed funds rate, that's the rate that the Fed charges banks to borrow, averaged 6% roughly from 1955 to 2000. In the last 20 years, it's been 1.4%. It's below 1% right now. We have negative interest rates in a whole bunch of European countries, which basically means, I mean, this is a dysfunctional capital market when you have to pay. You're supposed to make money when you loan it to somebody. You have to pay a bank to take your money. That's what's happening in Europe. So this is extremely dysfunctional. And by the way, just to give you a tangible idea of what that means, when you look at retirement savings, if you take the amount you need to save to retire well, if expected interest rates are no longer what they used to be, 3, 4, 5%, but now they're less than 1%, you basically quadruple the amount of money. I mean, we have such a huge deficit in our retirement savings right now. It's the ultimate indicator that we're kicking the can down the road. Our real estate markets are now back. Us and the rest of the developed world, yet alone the developing world, are back at ratios, income to rent, income to buying ratios that are higher than they were during the financial crisis, before the financial crisis. So we've reinflated real estate markets, and a really good indicator sometimes of what we call bubble-like conditions, the price earnings ratio, how much you pay for a stock versus how much earnings per share exist. In the United States, the average PE from the 1950s to the 1990s was basically 15. From the 1990s through the 2010s, it had increased to 25. Now, in the last couple of years, it's gone all the way up to 35. The average price earnings ratio on the S&P 500, more than twice what it averaged for basically 50 years. This is a bubble market. It can't stay at that level forever. So when you look around, and there's other indicators, commodity prices, other such things, but what a lot of people, all they do, they borrow money for their mortgage. That's all they know. We are living in an era of extremely dysfunctional capital markets because we've got this debt party that is not going to end easily. And as you said, not going to end soon.